AGNC. It's got a 12% dividend, and it's a REIT, and it seems like it's government guaranteed. So a lot of people pile into it, but it's not risk free, and I'll show you why. I'm gonna go into the into the stockanalysis.com, and we're gonna do a little overview here. Check out its performance during the last day, 5 days, 1 month, 1 year. That's year to date, 1 year, 5 years. It seems like it's a downtrend, but it gives a 12% dividend. So is it a buy? Is it just really undervalued? Well, let's find out. First, I'm gonna click on the financials here to try to find out some information, and we won't be able to find out much information because the REITs do a lot of financial gymnastics. I'm gonna click quarterly. They do lots of financial gymnastics, so you can't really learn that much from these statements, except one thing here. Do you see this? Shares diluted. This means that whenever they're not able to meet their obligations, they'll just issue more shares, or if they want to buy more debt, they'll issue more shares, and then they'll dilute you. So you won't own as big part of this REIT as you once did. So that's important to note, okay? So that's one risk to owning this. If we go in the statistics, we also won't find out much except this top line here, market cap versus enterprise price value. So the market capitalization of the fund is 6.36 billion, but the enterprise value is 60. What that means is they're leveraged like 9 to 1. I mean, they have $53 billion of debt, which they need in order to operate, because that's what they do. They take on debt and they buy more debt and they pay you out the difference. So hopefully with enough leverage, with enough debt, that's worth it. And it seems like it is. And I want to draw your attention to some things though. When we go over here into the profile, that many people buy this because it's, government guaranteed. Over here, guaranteed by the United States government sponsored enterprise or by the United States government agency. So it seems like this is basically easy money. I mean, you're going to get money no matter what. If the payers don't pay out, the government's going to pay it. So free money, right? Well, not so fast. First of all, I did some digging, and only 2/3 of the funds are actually guaranteed. So there's still one fund in mortgage-backed securities and just filler kind of debt that's not necessarily risk-free, so to say. And on top of that, there's another thing I want to draw your attention to, which is their dividends. So first of all, these numbers are a bit screwy, right? Because, payout ratio negative 77.4. That means they're going in debt further as they're paying out these dividends. Basically, charging one credit card to pay for another. But this, it's not abnormal. There can be periods of strengths and weaknesses in these funds. That's fine. But one thing I want to show you here is look at his dividends and how it's been dropping over time. To get a better look, this is the chart. So in September 2018, the dividend was $1.25, and then it dropped to $1.05, and then 80 cents, 65 cents. In 2014, it dropped from 65 cents to 22 cents, and then to 18 cents. You can see the trend here, 16 cents, 12 cents, and percentage move. These are actually really big drop-offs. I mean, from 16 cents to 12 cents, that's quite a bit, right? That's like 20-30%, something like that, 20%, I don't know. A drop-off, it's quite large. And it continues to drop, and that's going to still keep happening until the fund keeps dwindling away. So they're not making enough money, basically. AGNC is not making enough money to meet its obligations for that fat dividend. So when you get that big dividend, it eats a portion of the principal, right? They're paying out the principal to you. So unless you reinvest it, you're not owning as much of the company or the fund as you thought you are. Okay? So if you reinvest the dividend, what you're going to get is the actual growth of the fund, right? So perhaps they're really yielding like 3%. And by reinvesting it, you're going to see the price or the total amount of money you have invested in the fund actually go up by some small amount. And that's going to equal the amount of the return that the fund is actually getting you. So it's a bit tricky. I personally really steer clear of funds like this that don't make it, don't try to come close to even, or at least even have it grow a little bit, right? Have the principal grow over time and only pay a small portion of the fund. So I personally steer clear just because the math is very hard to do, and also because I don't know what I'm getting, right? It's really hard to try to figure it out. So I don't like AGNC for that reason. I do like that their debt is guaranteed, but I don't like the gymnastics. A fund that I like better is Realty Income, which, let me look it up here for you, which pays a ton less. Okay, so the dividend for Realty Income is only 4.11% at the moment, but if you see over here, it's actually growing. Okay, so over the past however much time you go back, this fund has been growing. You can see here it was in 2012 it was 15 cents, and then in 2013 it was 18.2, 18.3, 19 in 2015, 20 in 2016. It grows very, very slowly, right? 2018 is 22 cents, but it's actually growing, and it's sustainably so. In fact, it even grew through 2008 in the financial crisis, where mortgages and housing collapsed. So they were able to manage that period, and they're still growing. It's probably going to be growing and paying out forever. And I know what I'm getting, and I know that I can compound. With AGNC, I have to reinvest constantly, and I don't know what I'm getting on the top. There's a really key word here in the profile. Sorry, let's go to AGNC again. AGNC. We'll go under profile, and look what it says here. The company has elected to be taxed as a REIT under the International Revenue Code of 1986 and would be subject to federal corporate taxes if it distributes 90% of its taxable income to its stockholders. So that's how REITs operate. So, they get special tax treatment if they distribute 90% or more. Okay, look, this is the key word here. If it distributes at least 90%. Okay? At least. So there's no hard rule that they can't distribute more than 100%. You see what I'm saying here? So they could distribute 91, 95, 99%, but they could also distribute 110, 150, 200%. Do you see what I'm saying? So they can actually distribute way more than they're making, and it fools a lot of investors. Like, many investors, especially ones that haven't been around the block, they think that they're getting a 12% dividend on their investment, when in fact it's a lot less. I don't know how much it is. It's hard for me to calculate. But if you do know how to calculate it, write in the comment below and let me know. But I just want to mention that for this fund, it doesn't actually matter how, what the holdings are, because they're guaranteed, most of them 2/3. So there's still a risk, by the way. And when you're leveraged that much, and even less than a third of your fund goes bust, you're done, right? But it doesn't matter too much. I'm sure they do a good job of acquiring specific type of debt or whatever, but it's just not. It's the structure that worries me. I don't like the structure. I don't like when they pay out more than they can, and I don't like when they issue stocks to try to cover it up, or not cover it up, but at least keep the fund healthy. So all these gymnastics are just not something I want to sign up for. So for those reasons, I'm going to steer clear at AGNC, even if the actual return, even though less than 12%, might be 6% and pretty steady, but I prefer to have a clear, growing dividend that survives for many, many years, and not have to worry about these gymnastics all the time and try to wonder, how much am I actually getting paid, and and what's the health of the fund today? How much are they going to decrease the dividend? Is it going to be halved? Is it going to get decreased by 10%? When is that decrease going to happen? Like, that's just too stressful for me. Okay, so I prefer to stay clear of agency. I know a lot of people actually like it, and good luck to them. I hope they're making a lot of money doing it. It's just not for me. All right, that's it. Peace out. To the next. Oh, by the way, I do these company reviews, ticker reviews. So let me know if you want me to do something that you're interested in. I'll do a review just like this and give you my opinion on it. So write the ticker down below and I'll look into it. All right, that's it. Peace out.